From a neurology student diagnosed with bipolar disorder to becoming one of the best investors in the world. From an outsider who was uncomfortable with interpersonal relationships to managing billions of dollars and being the protagonist of one of the most incredible stories in the stock market history. This is the story of one of the most controversial, contrarian, and followed investors of all time, Michael Burry. Michael James Burry was born in San Jose, California in 1971. At the age of 2, he underwent an operation to remove a cancer that caused him to lose his left eye, something that Burry would consider to have marked his life, making his childhood difficult due to the teasing he received about his prosthetic eye. Although he was always athletic, contact sports could cause his eye to come out, as well as take away his depth perception, so he ended up becoming fond of swimming. Burry attended Santa Teresa High School in San Jose and the University of California in Los Angeles, where he began studying medicine, although he also took economics classes because he had always been a big fan of the stock market and was passionate about the subject. He graduated as a doctor from Vanderbilt University, and although he enjoyed studying medicine, he did not feel comfortable with the practice, which often disgusted him. And once in the midst of 14-hour shifts, he disassembled and reassembled a computer in order to make it run faster. This caused him to be sent to a psychiatrist who diagnosed him with bipolar disorder. Burry asserts that this diagnosis was absurd because he did not present any of the symptoms. However, this would not be the first time that he would do unusual things in the midst of long shifts. And in 1996, he began a forum on techstocks.com called Value Investing, where he would share analysis and opinions on investments. But he quickly found that other people's opinions did not contribute much to him, and he moved on to create a blog, which he worked on from midnight to 3 a.m. in the midst of 16-hour shifts. In 1998, he began his residency in neurology at Stanford Hospital, but always kept what he did in his free time hidden from his colleagues, but not from his followers, always signing as Dr. Michael Burry, something he continues to do to this day despite having left medicine. His popularity on the internet grew to the point where when he criticized index funds, he received a cease and desist letter from Vanguard Group lawyers, which made him realize that not only small investors were following him, but also many institutional ones, leading him to make a radical decision with his life. Michael Burry left medicine, returned to San Jose, and married for the second time someone he had met through Match.com, where he had described himself as a medical student with one eye, awkward social manners, and $145,000 in student debt. He was determined to create his own investment fund, but he only had $40,000 in savings. However, his family received compensation for a medical error that caused his father's death. His 3 brothers contributed $10,000 each and his mother $20,000, serving as a foundation for creating his Scion Capital fund, named after one of his favorite books, Terry Brooks' The Scions of Shannara. Thanks to the good results obtained by those who followed his blog, Michael Burry was able to capture the attention of investors who began to seek him out to invest in his fund, with Joel Greenblatt of Gotham Capital being one of the first to meet with him and offer him $1 million for 25% of his fund. Later, White Mountain would give him $10 million to invest. In all these meetings, people always asked Burry how he had been able to perform such analyses while studying medicine and working as a doctor, and Burry attributed it to an obsession with productivity, as he always sought to be more efficient and productive. Burry, however, quickly realized that it was an industry in which he would have to interact with people to get them to invest in his fund, and also that he disagreed with many things in this business, such as how risk was measured. In finance, both academically and for investment funds, risk is often measured as the volatility of investment returns, something that for many has been an absurd measure, including for Burry, who claimed that in this context, $100 obtained with low volatility was more valuable than $100 obtained with high volatility, but this made no sense because they were the same $100. Demonstrating some traits of his contrarian investment philosophy, which he would maintain throughout his career. Michael Burry was a follower of value investing and had studied Benjamin Graham, Warren Buffett, and Charlie Munger. However, he felt that this only gave him the foundation of thinking, but believed that each person should adapt their investment style to their personality, and considered it unlikely that he would become Warren Buffett. In fact, he believed that Warren Buffett, although known for being Graham's student and for following his investment methodology focused on finding highly undervalued companies, did not actually invest that way, and had adapted his style to focus on quality companies at fair prices and avoided bad companies at excessively low prices. Burry also believed that he would never be like Buffett in terms of his wise and friendly grandpa image, and although he knew that Buffett, like him, had serious problems socializing and talking to people until he had taken a course with Dale Carnegie, author of How to Win Friends and Influence People, he thought that the internet was now the new Dale Carnegie and preferred to be direct, even if it caused annoyance to other people. And in this, he identified a lot with Warren Buffett's partner, Charlie Munger, who was known for being direct, blunt, and sometimes even rude. Additionally, Munger, like Burry, also has a prosthetic eye. And in 1995, Charlie Munger gave a lecture called The Psychology of Human Misjudgment, which resonated enormously with Burry and probably with anyone who sees it, because it is a masterpiece. In this lecture, Charlie Munger mentioned the psychological biases that people have and how they lead us to act in a particular way. One of the many biases explained is incentives, where Munger uses FedEx as an example. Because FedEx was having an efficiency problem where it was not able to process packages to be sent on time, and after trying many things, it ended up finding a solution by changing from hourly pay to shift pay, thus changing the incentive from wanting to work more hours to receive more pay, to wanting to finish as soon as possible to go home. Burry had seen firsthand how incentives could be extremely dangerous in medicine and how government subsidies for certain procedures caused hospitals and doctors to perform them more, to receive more money. And he wanted to make sure that the same did not happen with his investment fund by having the appropriate incentives. Funds usually charge around 2% on the assets they manage, and this becomes a great incentive for them to raise as much money as possible, while profitability fades into the background. Burry therefore decided to charge only for the actual expenses of the fund, which were much less than 1% of the assets managed. The results of Scion in the first years of operation were impressive. In 2001, while the S&P 500 fell 11.8%, Scion gained 55%. In 2002, the S&P fell 22.1% and Scion gained 16%. In 2003, the S&P rose 28.7% while Scion gained 50%. In 2004, both rose 10%. And in 2005, the S&P rose 6.8% while Scion gained 7.8%. But how was he investing to achieve such results? Michael Burry focused on finding investment opportunities where no one else was looking, and one of his most well-known investments in his early years was in the company Avant Corporation, which Burry found by looking for companies that had been sued but whose fate had not yet been decided in court. Avant was a company that had been accused of stealing the source code of its software and was being sold in the market for $250 million. It was heavily hit by the scandal, even though it generated annual cash flows of $100 million and had reserves in banks of another $100 million. Burry noticed that most of the company's employees had work visas and therefore had to keep their jobs to avoid losing them. So even if the company's executives were found guilty, as was the case, and the company had to pay a fine, as was also the case, Avant would still be worth more than the $250 million for which it was being sold in the market. Burry began buying shares in 2001 for $12. After Business Week featured the company's executives on its cover, the stock plummeted to $2, but Michael Burry kept buying until he became the company's largest shareholder. He pushed the management to focus on cleaning up its image, and succeeded because the company was eventually acquired for $22 per share. This was called a classic Michael Burry operation, where half the money is lost at first and then the investment earns 10 times the initial amount. His results quickly made him close his fund to new investors, even though the operation that would make him known around the world was yet to begin. In 2003, Michael Burry began to notice something strange in the U.S. housing market. With San Jose houses increasing in price despite the dot-com bubble bursting that had affected the entire country's economy, especially California, which had been the epicenter of it all, Burry realized that this was possible thanks to absurd conditions of mortgage loans that artificially inflated demand. On the one hand, interest rates were extremely low, and on the other, commercial banks had come up with a whole series of options to grant loans to anyone regardless of how low their income was, such as not having to pay the principal of the loan in the first 2 years. Burry began to question why these banks were granting loans that would clearly default when the periods in which people paid practically nothing came to an end. And he realized that it was because as soon as these loans were made, they were sold to investment banks, which packaged them into financial instruments known as MBS. MBS, or mortgage-backed securities, are instruments where a large number of mortgage loans are combined and divided into several tranches with different risks and returns. When people pay their mortgages, the money goes to the highest tranche, which is the safest and pays the least return, and what is left pays the increasingly higher returns of the lower levels, with the last ones running a high risk of not receiving money. Burry noticed that MBS had changed radically, and what was originally a very safe instrument that had allowed people to decrease the interest they paid when buying a house had become extremely blurred, and now many included a large number of junk mortgages, with low credit scores and defaults increasing. However, it was not possible to directly short these instruments, so he had to resort to CDS. CDS, or credit default swaps, are instruments that work similarly to insurance. The person who buys a CDS pays a premium periodically, as an insurance, and gets money if the insured risk materializes, in this case, the default of a financial instrument. And Michael Burry began to buy CDS on different tranches of multiple MBS. As during 2005, 2006, and part of 2007, house prices continued to rise, and the bubble could be sustained, Michael Burry had to pay increasingly higher premiums for the CDS, and his fund came under serious pressure from his investors. However, time would prove him right, and Michael Burry would make profits for the fund of approximately $800 million when the bubble burst and MBS tranches began to default, resulting in the book The Big Short by Michael Lewis and the movie of the same name, where Michael Burry would be played by none other than Christian Bale, making him one of the world's most popular investors. In 2018, Michael Burry began buying shares of the company GameStop, which is primarily dedicated to retail sales of video game-related products. He began writing to the company's executives, encouraging them to change their strategy, which was focused on clumsy diversification, when according to Burry, they had the opportunity to buy back their shares, which had an extremely low price due to all the short-selling transactions against them. Burry continued to write to the executives and became increasingly critical of their decisions, and by April 2020, he had acquired 3.4 million shares at an average price of $4, giving him control of 5.3% of the company. But everything would take an unexpected turn when Keith Gill, known as Roaring Kitty on YouTube, began talking about the stock on Wall Street Bets, a subreddit where people discuss investment ideas. Members of this forum saw the opportunity to buy an undervalued stock and cause big losses to those who were shorting it, which is exactly what happened, and the stock reached a value of over $120 in January 2021. In early 2021, Burry declared that he had closed his position in GameStop and is estimated to have made a profit of around $250 million, but he was later very critical of the absurd speculation that had originated with GameStop and had spread to AMC, BlackBerry, Nokia, and other stocks that began to be known as meme stocks. Although these companies initially had significant rebounds, which they were able to take advantage of by issuing new shares to raise capital, eventually the movement lost steam, and most stocks returned to their prices prior to all this, with the exception of GameStop, which maintains a share price above $20, demonstrating the potential Burry saw in this company. Michael Burry doesn't usually give interviews, but he has expressed his opinions on a wide variety of topics through his Twitter account, which he named Cassandra after the Greek figure who prophesied the fall of Troy but was ignored. Burry has been negative about the current state of the market, the economy, government management, the Federal Reserve, and investor behavior. He has stated that just like in 2007, no one listened to his warnings. Burry often posts tweets that he quickly deletes, many times with cryptic messages that leave a lot of room for interpretation, but are saved by other accounts like the Michael Burry archive. Some of the most relevant opinions he has given in these tweets and interviews over the years are: the end of Bitcoin. Michael Burry has stated that it is only a matter of time before Bitcoin disappears because central banks around the world will never allow an alternative currency to take away their power, with the ban in China being just the beginning. Burry also believes that cryptocurrencies are a bubble inflated by speculative frenzies facilitated by the excess of cheap money in the economy for so long. Burry has also been very critical of index funds. Index funds track major indexes such as the S&P 500, Dow Jones, and Nasdaq. But they have grown so much that now the largest owners of the leading U.S. companies are passive investors through index funds, who do not exercise control over the company's executives and allow many mediocre companies to rise in price and bad management to stay in their positions. As people invest money in these funds that are then used to buy all the stocks in the index, a large number of bubbles have formed in companies that receive part of this demand, despite their poor results, and end up rising in price, attracting people's attention. Burry was a strong critic of quarantines during the pandemic, government subsidies, and the Federal Reserve's monetary policy, considering the monetary stimulus excessive. He believes that it is now very likely that the Fed will lower interest rates too soon and make the same mistake as in the past, whereby believing that inflation had been resolved, interest rates were lowered, and later it was necessary to raise them much higher. Burry has also been critical of the U.S. government and the little attention paid to the increase in debt, which has limited monetary policy and could turn the government into a pyramid scheme if it continues like this, as it cannot increase taxes enough to pay its debt without resorting to printing dollars. These criticisms have also shown a leaning by Burry towards the idea that China will surpass the U.S. as the world's largest economy, although more due to the mistakes of the U.S. than to good decisions by the Chinese Communist Party. Finally, Burry has considered Tesla as a bubble on multiple occasions, and although he sees Elon Musk as a good person, he believes that the stock price has reached absurd levels. And while Tesla has lost half its value since its peak in late 2021, it is unclear whether Burry was able to benefit from this operation or if, on the contrary, he incurred insignificant losses. Although Michael Burry has been heavily criticized in recent years and has been called a broken clock and a very pessimistic person, time will tell if, like in the mortgage crisis, he was correct with his warnings. I hope you enjoyed this video. If you did, you may want to watch this one next. I would also like to hear your opinion about this successful investor. See you next time.